Good morning, everybody. Good morning, good evening, good afternoon, wherever you are. It's always a great trend following day, isn't it? Friday, wrapping up probably a decent week, I guess. Since I don't look at performance, I don't really know. But it's been some interesting moves. I'm interested to see what everybody is making money in or losing money. Um, so, and what's on everyone's mind. I always admire Derek for having a specific agenda and a specific topic. See, my personality versus his, you can tell a bit right there. And all I can do is come up with a free for all discussion, right? So let's have our free for all, our fun time, and talk about what's going on. One of the things that caught my eye this week was the dollar yen is doing some trending. I've had my short yen position for quite a while, but I just started trading the yen crosses, euro yen, Swiss yen, sterling yen, Aussie yen, Canada yen. So I guess those are making some money as well. So the yen looks like it's an interesting new development to go along with all of our well-established trends, well-established indeed, but of course that means nothing. They can turn around violently, quickly. I got out of my nickel, well, some of my nickel, pretty big sell-off there. And started going right back up. I guess I'm a little glad, I'm fighting the last war. I got out, so I kind of wish nickel would go down to validate that. But then I have some left, and okay, so I guess I'm financially glad it's going back up. My takeaway on this nickel is just thinking that in order for me to make money in these markets, I have to sit with an unbelievable amount of volatility, but even worse, it's just the possibility of watching so much of the profit go away, and then how intolerable that can be. As a money manager, am I supposed to manage this, more than I am, just simply sitting back and waiting for the long-term breakout exit to occur? Um, but it's just so, it seems to be such a requirement that if you don't have the wherewithal to sit there and essentially let it go away, the profit, you may not be as successful. So I'm even more like determined to, from a pure profit point of view, not to get caught up in volatility and volatility targeting and exiting before a lot of pain has happened. Anyways, I'm interested in everybody else's thoughts. I'll start bringing people up. There's my buddy from
Uh,
Russia.
yeah, hi to everyone. I'm very happy, as I always said, and it's really straight from my heart. Always very happy to be here. And now I'm in Belarus. I went to Belarus because I need to make a visa, because in Russia visa is restricted, international visa, because I trade in Collective 2 service, and I must now pay for my service annual for a year. And I came to Belarus and did my visa in Raiffeisen Bank, and I'm hoping that it will be working. Nobody knows it exactly, but I'm hoping. I did not came to another country, did not come because I don't have documents for crossing the border, and it take time to do these documents. It cost foreign passport in Russia, so I need 1 month for this, and so in Belarus I can go without a foreign passport, without crossing the border procedures. So, and I'm happy to be here, and a lot of beautiful and kind people, a lot of beautiful buildings and beautiful nature. So, I'm very glad to be in Belarus and to be here with you.
And we're glad to have you, Oleg. Spasiba. Bolshoye spasiba.
Like you are Russian. Good accent, good Russian accent. I like it.
It's been 35 years since 8 semesters of undergrad, but I guess it paid dividends one day.
I don't know what to say, but I think that. And why did you decide to learn Russian language?
Not to get off topic, but just child of the Cold War, military, so just Sun Tzu said at the time it's wise to study the ways of one's adversary. And so, you study that. And then the army also taught me Kurdish. So, Kurmanji of the two dialects, you got Sorani and Kurmanji, and Sofla, the foreign language, taught me Kurdish in the army. So you just keep moving.
Okay, interesting information. Thank you for your answer.
And for the record, I don't think of Russia as an enemy, even though we got stuff going on, like we said earlier. People are what matter. Governments are all jack-a-mode, regardless of where you're at.
Yes, and I'm very happy when people in Russia say something that they want peace, and I'm very happy when I see such people, and I see such a lot of such people in Belarus. All people in Belarus with whom I was speaking said that war is an awful thing, that they all want peace. And when somebody says that he wants peace, I feel like he is my close friend or even a brother, and it's very important for me. And I think if people will want peace, all the people, it will help to be our world the best place than we have now. And I'm sure it is so. And in Russia, also, I was speaking with one guy, and he was a taxi driver, and he said, "I was in war, and I was in war, in Chechen war. It was in the Caucasus." And he said, "I saw war. And I hate war because I saw it, and I'm for peace." And I thought this guy is like a brother for me. I was very happy to see such. I'm very happy when I see such people. Not all people are such. Not all, of course. Some people watch mainstream videos, mainstream news, and it's awful. It's awful. But not all, of course, not so many. Maybe I don't know. This is the data, the statistic here, but I see a lot of good, kind people.
Well, anybody who's shot at people or been shot at realizes that there's no romance at all in it.
I've been traveling as well, but I couldn't pass up to join the group. So might be listening more in the background, but happy day. Happy to hear new perspectives or old perspectives as well, of course. But just happy to be here.
Hi, everyone. G'day, Jerry. Are you back from your holidays yet from New York?
I'm back. I'm tired of traveling. We had a great trip down to the British Virgin Islands. And so I live in Tampa. I don't need to go anywhere for sun and fun, but it was my 11th wedding anniversary. So we have a little tradition of trying to go down there. And it's our first time in before COVID. So it was fun. I got sunburned, but I had a lot of good food and a lot of great wines as well. So, but glad to be home and glad to be back in the normal part. I'm getting too old to enjoy long travels, and even though I don't look old or act old, according to me, of course, I really like being home. How about you?
Yeah, I'm a bit of a homebody myself, to tell you the honest truth. It's nice being back at home, but I was listening to the podcast between Alan and Niels this week, and Alan's right. These currencies are certainly getting a bit of a kick on at the moment. I noticed that the yen pairs are just absolutely zooming ahead, and anything associated with euro is going down. So, there's some good trades here, and I noticed that, look, I am still managing to hold on to some of the earlier trades like wheat. I'm sort of doing well on cotton too. Keep my eye on cotton. But I'm not trading the soy meal or soy oil, but anything associated with soy seems to be going, skywards as well. So still very good trending markets.
Yeah, Alan actually brought up that dollar yen, and I was not really thinking too much about that trade, but I guess I'm a little baffled from a fundamental point of view as to, you know, I think we need higher rates due to the real rate, interest rates being negative, and we're going to have higher rates, and yet it doesn't seem to be hurting the stock market. And I said a few weeks ago, it looks like the Fed is now buying the S&P, tongue in cheek a bit. You know, I'm not really sure, but you know, I don't care. I've got some long single names. I'm short a few indices. I mean, it's really not anything I concern myself with, but it does seem that if I didn't trade technically, maybe or trend wise, I would be a bit confused as to how, you know, we can have this big bull market and ignore valuation because rates are so low. Now uh, we can have this big bull market even when rates are going up, and maybe like 2 or 3% is not enough. They're saying maybe, um, but where are we off to with these rates? I think. I guess when I say we need to have higher rates, I don't even know. I'm not qualified to even say anything about that other than logically, I would think that rates need to be around the level of inflation.
Yeah, look, to be perfectly honest with you, I don't know whether I'm getting dumber as time progresses. I think I probably am, because I'm certainly not paying attention to any fundamental viewpoint of these markets. I've sort of been sold on this principle by JP that the dominant reason for price moving is collective impacts of trader collective impacts as opposed to fundamental value. You know, like things such as fundamentals and different factors. It's a bit like correlations. They swing in and out of being correlated or swing in and out of being causally linked. And I think the primary thing to keep the eye on is always what's price doing. So, when the fundamentals are saying something that makes you think, well, we've got to be long or we've got to be short, really you've got to disown that and look at what the traders are doing. What is price doing? And so, often there are times when, price is moving the other way to what sound fundamental rational investors would be considering. And I think that's the way we've got to trade it. We've got to follow where this trader impact or the flows of the market are sort of moving. And, I noticed that Alan, in his conversation with Niels, was talking about, his reasons for different trending environments. But I think it actually fundamentally comes down to a decision that 100% of that price move is actually created by trader behavior or trader impact. I sort of tend to subscribe to that view. And things such as fundamentals or things such as different risk premia are sort of more sort of loosely correlated with that behavior, but it doesn't necessarily mean that they'll always be aligned.
I guess that also puts the onus on what is the action and what's the impact of the action. So maybe, again, not to go back to what we discussed before, but maybe certain environment actions do cause obviously what the market is doing, but the actual impact on the price is who's trading on that price. So that's the actual direct impact, not the indirect impact. So that's also why we are looking at price, because the direct impact is on price, and all the indirect factors might be causing it, but that's indirect.
Exactly, Jeffrey, and they might be just loosely correlated. What really hit me over the head was this: when you look at both informed traders and what you call noise traders taking positions in the market, and you look at this research in relation to the square root law, you realise that any trader, whether informed or ill-informed, has a direct impact on moving price over the long term, and this is even amplified further when they're actually trading a basket such as an index as opposed to an individual market. You can't get away from that fact that the direct impact that we're talking about is from trader behavior, but there might be these indirect, at certain times causally linked premia or factors, but I'm so glad that we are looking at the primary impact, or the price action itself, as opposed to any derivative associated causative factor.
And I want to say to you that I said before it once that I think that if you do fundamental prediction and if you do prediction based on a chart, it's the same probability of the things, but if you do the chart prediction, it will be more simple, much more simple. But of course, we are trend followers. We don't predict the future. We trade the markets with all the rules. Do algorithmic trading. We have the rules. But if a trader don't have any rules, he is a predictive trader. I think it's not necessary for him to learn all this stuff, all this analysis. It's not necessary. It's only he can take a chart, maybe monthly charts, and see where the trend on the market, particular market, goes on. So market goes down, long-term trend, or market goes up, and so there is very high probability that it will be going in the same direction. So I think that, of course, if we do a prediction model here, it will not be effective, very effective. But if we do a prediction based on news or something like that, fundamental factors, I think it will be the same probability of being right. And so I don't see the sense for me personally in both cases. But if you want to be a predictive trader, why to learn such a lot of information? You can learn how to understand the direction of the chart, nothing else.
I kind of want to build on the two comments from Richard and Oleg. I mean, I agree with Richard, but I think I would expand the scope a bit. It's not just like the trader's point of view, it's flows, right? And the flow of capital towards some asset or away from some asset. All assets are owned by someone all of the time, because for every buyer there's a seller, and for every asset there's an issuer. So by design, we must have someone holding everything at some period, unless it disappears or is delivered or consumed by a commercial or something like that. I mean, as it is consumed by the system. But I think that going to what Oleg says, just looking at the chart and doing this kind of macro aspect, and I will put value investing in equities. I mean, I think it's a great example. It's a simple one that we all understand. Is that there's a feedback loop. There's a feedback loop between the flows and then the fundamentals. What can happen is a lot of these fundamental things are some kind of ratio, and they will probably include some kind of price or value metric. And so again, by by the math, it is necessary that the price impact will affect those corporate fundamentals, which will then make that asset potentially more or less say appetizing for someone to take on their risk. So I don't think that one is more loosely decoupled than the other. I do think that there's a lead lag effect. Who is triggering the flows? Which participants have more dry powder that are becoming active in the market? And I guess I can give an example. We can imagine that before a trend occurs, we have value traders coming in and turning the previous downtrend into an uptrend because they think it's oversold, I guess is the word that they use. Again, I'm not a technical trader, but then there becomes a point where they've run out of dry powder. They've allocated to the point whereby they think that this is now fair value. And then we can have the trend followers come in after it's broken out, and then now this party has the flows, and so you can have this kind of cyclical element. There may be a point where then you have like growth people or something coming in after it's already had the next quarter's earnings that's showing that, and they're actually trading earnings momentum, so to say, or something like that. So I do think that they're linked. Who is leading, which party or which strategies or which funds or which flows are leading it, but absolutely at its most essential, it's how much more flows are willing to pay more or less for something.
Yeah, it's quite interesting because obviously if you look at value, there are cases or times where that's the leading factor, and that actually plays a good time or good timing for those type of traders to actually jump in and maybe buy or sell. Um, but then it's very hard to kind of distinguish if you're not looking at the essential, and maybe there are other people obviously that are better in it, but if you're not looking at just price, it's very hard to see which one is winning. Is it the growth traders focusing on growth, or focusing on value, or focusing on, so that's why sometimes keeping it simple, in my opinion, is easier and better, but obviously sometimes as well harder, because then you have all the other concepts that we have with trend trading that you have to follow, which is against our almost human way of thinking of not predicting, or predicting in the sense of following price. So yeah.
Jeffrey, I think you made a very interesting point, and I don't want to dig into it too much, but I do believe every dog has its day. Every strategy will go in and out of favor. The benefit of trend following, as we think of it, is that it allows you to survive very easily the times where you're out of favor. But it's not necessarily true that you will be in favor all of the time. We know that we will have a lower win rate than 50% and things like that. I do believe value can be profitable over the long term over someone's career. I do believe that momentum, growth, and all these things can happen. But a lot of the mistakes are made, the human mistakes, the non-systematic mistakes are made when they're out of favor. I do believe if they were able to, say, get rid of that psychological aspect that trend following puts into you by the golden rules, um, you would see a lot more of these discretionary type traders have more success.
I agree.
Hey guys, glad to be here. This Clubhouse has become one of my highlights on Fridays. I have a question to futures traders. I have recently replaced some of the ETFs that I trade with futures because as an European, I need to trade some of the, for example, S&P 500 ETF on the London Stock Exchange, which is much more expensive than in the US. And now I've come to the futures that are quite cheap to trade for me. And when I trade highly liquid US stocks, I usually just hit the market order into the close or at the next open, because for my long-term trend following strategies, it's irrelevant to micromanage them with a limit order. But I have a question about the liquidity of the futures, because I trade the stocks and ETFs only at regular trading hours. But what about the futures? Let's say the E-mini and micro E-mini S&P futures outside the regular trading hours, let's say several hours after the market has closed. Do you think it's still safe to use a market order, or should one consider a limit order just to avoid a situation where you hit the market order and match it with someone's high limit sell order and get like a different price than you'd expect?
I'm no longer trading on a daily basis, but I'm sure that S&P futures is very liquid. And but I always like to use these limit orders. Back when I started trading, we were trading very small, and then we were taught the benefits of limit orders, and and so we would put these 1 lot and 2 lot orders in with limits. And kind of funny, we were just trying to do what we were told. But the key is that with the limit, you're going to put the order in at the market or a bit below the market to buy. And then the problem is you're going to have to chase it sometimes. So human beings don't like to think about a big problem. And so you're going to be able to say, hey, this limit works 90% of the time. I put it close to the market, a bit below on the buys. It comes down, I get hit, and I'm versus if I do a market order, it's a little nick every time. I'm just going to lose a bit. It's almost imperceptible, but we kind of prefer that versus, oh, I have this story of chasing this market all day long with limits. So I don't like that story. I don't like that amount of pain. But with a lot of things like trading, if you look at it over a long period of time, the limit orders will really save you more money. Irrespective of liquidity, for instance, if it's really liquid now, I just throw in a market order. I think that's something I try not to do, because if you just exercise a little bit of patience and be willing to put yourself into a little bit of pain, that yes, you are going to have to chase the market sometimes. Overall, your trading performance will be better. And I think that some people, though, that I highly respect, that are really good traders, famous traders, their attitude upon hearing that sort of strategy is, I only do market orders. I don't want to think about it, worry about it, and try to get a bargain. And so what if I get a little bit of negative slippage every single time I do a trade, because I'm only doing these market orders? I don't care. I'm going to do them anyways. So that's the two sides of it. But I think whenever you go in to do a trade, any time of day, you need to sort of size it up and see, if the liquidity is there to handle the type of order you want to put in.
Thank you for the answer, Jerry. And actually, something that I noticed today which was a pleasant surprise for me, that CME has now also the micro Bitcoin futures. And so before I couldn't trade the Bitcoin futures because it was like 5 times the Bitcoin price or something. But now the micro futures is like 1/10 of the Bitcoin price, which is good news to me, that such a product is now available. So I don't need to use any of the crypto apps.
Yeah, I started trading and looking at those micros, Ether and Bitcoin futures as well. I know we preferred the larger ones because the better liquidity, and I think we experienced some lack of liquidity around spreading as well. And you have to spread them every month. That's a pain. But I'm pretty sure there are ETFs with the futures that you could access as well. I know they have a management fee, kind of a pain, but yeah, I definitely like trading the cryptos. And I started getting ready to add some stocks, miners that are, and other companies that are associated with crypto, that hopefully to get some diversification and create another asset class: currencies, commodities, stocks, bonds, and crypto. But they seem to be highly correlated with the companies seem to be highly correlated with the movement of the Ether and Bitcoin. But of course, that's not going to stop me. I'm still going to diversify into those a bit. But yeah, I like those markets quite a bit. I think it's the wave of the future, of course. And I was going to say that another good idea that I have as far as finding new stocks and diversified stocks and interesting things is I look at these ETFs. There's a couple ETF companies out there that like make it their business to come up with these new ETFs with a lot of companies in the ETF that offer quite a bit of diversification. So I mentioned that before, but that's one of my main drivers to improve my portfolio. We have the chat open, so the room chat, if anybody wants to put questions in there, I'll happy to bring them in front of the group.
Hi, everyone. I'm reading Jerry's most recent Twitter about love your drawdowns. And I feel like, oh my gosh, I'm always anxious about drawdowns. And to me, that's counterintuitive. So, Jerry, would you please tell us a little bit more about it? Thank you.
Yeah, another tweet totally due to good red wine. So that was the get my brain and thought processes going. And it's just building on what I said earlier that, oh, yeah, that in these particular markets, when the markets are good, which is what we play for, in which we have to maximize these outliers. I said last week, I'm almost to the point where I think we need to be way more concerned about missing out and staying in than we would be about giving up those profits. And that's counterintuitive. And so that therein probably makes it something we should definitely consider since we don't like it very much at all. And the more for a good trend follower has to get back in. That's the problem. We have to get back in when we get out too quickly and it goes back to the highs. And now the ATR is much different. It's much larger. The position is much smaller. If there's a second or third or fourth leg up, we're not going to make nearly the amount of money. And this is what the computer says on the back test. Trade these long-term systems. The markets will have these gyrations, but these trends can last 1 or 2 or 3 years. And you're holding on to that entry ATR, which is probably a year or two old and very small, and your position is huge. And you've convinced yourself, the computer is encouraging us to think of this as a trade and this volatility as not being risk, but as something we have to endure to get even higher and higher prices. And we've seen this in spades so much this year that trying to get out of these trades and worry about these drawdowns that own profits that are going to look very small over the next months. We were worried about this small profit going away in Tesla. Then all of a sudden it becomes one of the biggest trades ever a year or two later after the initial major drawdown of, I think it was a 50 ATR profit, and then it gave back 49 ATRs. So that's kind of the deal. Now it became a 500 ATR profit. So I don't know how to robustly get that 500 ATRs with my one entry, one exit, and a stop loss, unless my trailing stops are kind of far away and the 500 is allowed to occur, but the trailing stop now could give back 100. So where do you want to be? Protecting the 50 or putting yourself in a situation where you can make 400 ATRs, oh well, with a 100 ATR drawdown. So it's just no good choices except overfitting, vol targeting, a second or third exit that takes into consideration the profit in the trade or the volatility in the trade, which I think is not as robust as I want to be.
Hi, Jerry. Hi, everyone. I'd like to comment on this question to Lulu, um, with a recent experience of mine. I've been on the trade of the treasuries, the future of the treasuries, and I was short, and then at some point in mid-February, the market reversed, and I was shook off. But then the price of the future went back down, and now went back in the trade with a much smaller position, because at the time I put my first short on, the ATR was, I don't know, some number, and then I was shook out from the trade. And when I was back in, the ATR was the double of what was initially. So I lost both the way back down from the price, because I was shook off at some arbitrary high price. Then I couldn't make it back from the price going back down, and then I went back in the trade in a much smaller position. So right now I'm back short treasuries, but much smaller. And for me, that I don't have infinite amounts of capital. Um, a similar problem, but even worse, occurred with the bond, the German bonds, because similarly, I was shook off from the trade when the price went up. I was short, of course, and now a new breakout appeared from a even lower price. I wanted to get back in, but the volatility has expanded so much that I can't even afford one single contract. I would like to trade 0.7 contract or 0 point something. So the thing is, if I was more tolerant of drawdowns, if my exits were not so trigger happy, I wouldn't be out from the trade, from the treasuries and from the bond in the first place. The thing is, I couldn't at the moment find a combination of parameters that make me comfortable enough to trade these more tolerant systems. Tolerant in a sense that they are more longer term, they tolerate higher drawdowns and such.
There you go. I mean, I can't say it any better. I mean, that's perfect. I love that. And there you have it. I mean, I can't, I'm not comfortable. And, we need to train ourselves to live with that, with being uncomfortable. It's the math and not the emotions. And one way to be more comfortable is to trade more markets and trade smaller, if you can, of course. Um, but, once again, this is what um, you can look at the back test, which is good, and then scroll through charts like 10 or 20 years of the 10 years. And you'll see these massive trends take place in the currencies, the commodities, the interest rates, stocks, and you'll see visually what happens in between the entry and then the obvious place where this market reversed, massively reversed. There's so much volatility and so much inconsequential um, drawdown in between there that means nothing. And that's the bummer. Limit up today means nothing. It can be limit down tomorrow. I mean, that's nickel, right? There's no way to predict, and it's it's very uncomfortable to sit with some of these trades because I feel so dumb. Like everyone knows you should have gotten out. I've had people sit me down, and clients, they'll sit me down and show me a chart. I remember this happening in the 90s with the DAX, and some obvious turning point in the DAX. It was maybe 2 weeks lower, 2% off the highs, and it crashed. And it was so obvious that I should have been out. And I think this is what bothers us is these profit give backs and the amount of pain and volatility we have to suffer through that is not comfortable for anyone. It doesn't make a lot of sense, except, and I'm not a big fan of visually, and visually saying, oh, I found something because I've looked at charts. I'm not a fan of that at all. However, if you do what I said, look to see in the big moves that are very rare, the amount of volatility that you will get prior to the market turning over. The computer will verify that and say, yeah, that's correct. But if you want to risk $1 to make 3, which I like that bet, and that's the kind of way I look at it. It's I want to risk $1 to make $3, then you have to move it out to a very uncomfortable level to where you'll never get bounced out of any of those short interest rate futures. Although I did get bounced out. Oh my gosh, I don't know if you've seen this chart, but you should look it up. It's ridiculous. It's the Shats. I was short the Shats, then I went long, and now I'm back to short, all in like just a few weeks. And it was just a crazy move, where, but it was one out of like 20 interest rates that I follow. I'm able to follow these interest rates, 20 of them. I'm able to be so diversified and with 175 markets because I'm using trend following, and I'm able to trade them all so small. My max risk budget is fairly healthy, but with 175 markets, whatever happens, slippage, whipsaws on any individual market, it's really not going to matter very much. I need to have a big move, a huge move to make money and to get into a bad situation as well.
I like your words very much about training yourself, and I have said before also I had such thoughts that we must train ourselves to be to feel comfort in an uncomfortable for almost all the people's circumstances. But it's our job, and we get rewarded for this. And I really like it very much, and I want to say that I was speaking in the train with one guy, Belarus guy, and he works for a Russian company, and he was going from Russia to Belarus, and he made Russian card, bank card, and I said, oh, it's a banking tourism. So I have invented a new word, banking tourism. And I want to say that he said that he tried to trade, and he spent a lot of time all day trading, especially I think when he's in drawdown. And I said that do backtest instead, not trade all day long. If you are worried, do backtest and see what you analyze, what you see, think about that. So doing nothing is also doing something, as we all know. And if you want to do something, do backtest. And Jerry said, I appreciate this word very, very, very much. And I said also before this words of Jerry that look at weekly chart. Look how the markets works. Look at these trends. And I agree with I'm doing my backtest. I backtest 1 week, maybe for a few minutes. I can backtest 1 week or maybe 1 month. But when I'm trading and I have a 1 month or 2 month or 3 month drawdown, of course it's not so easy like a backtest. But because I have seen this backtest for many, many years, and I understand that I must be consistent, I must follow the rules. So, and it's the only way to be right here, to win in this game, to follow the rules, to be consistent, to trade small, like Jerry teach us.
Oh yeah, I forgot about the weekly charts. Oh, this is so helpful. That's how you can put 10 or 20 years on your screen. And instead of doing a 100-day breakout, you do the 20-week breakout, and then you can see what happens. You can see the trends and how they pop out in this endogenous world of trends that they do last a year or two, a year on average. I mean, I do one trade per year on average, but some of them go a lot further. And then on a bad day, where, oh yeah, I already talked about how I really hate, you have this profit during the day and the market made a new breakout, a new high, and it closes on the low or in the middle of the range, and you're like, oh gosh. And then whenever, or you lose a ton of money just in giving back profit that you've already made, then it's really beneficial to put up those weekly charts, and just, it's pretty obvious that whatever happened today didn't really matter. It's not going to matter for the next day either. So weekly charts, yes. And then what I did is I looked at the weekly charts in all of the markets. I looked at the big, huge trends. What does it take to keep me in that trend? It's going to be very uncomfortable. The 100-day low, the 200-day low, and how much profit does it require to maximize? How much drawdown does it require to maximize those profits? It's very uncomfortable. And then you confirm it with the back test. And the back test says, oh yeah, your eyes did not deceive you. In order to get that 3-to-1 payoff and make the most amount of money per unit of risk loss, stop loss, you have to get out there on that look back period and let the markets do their thing. It's so difficult. Easy to talk about.
Jerry, I get the most people have this misleading notion that you have to be right just just a little bit above half of the time. But in our trend following world, that's not necessary. You just said that we're looking for bets that pay 3 to 1. And when I run my back tests, I found that these longer term systems, they have a lower hit rate. Some of them have a 20% hit rate, some of them 25, and whereas the shorter term systems have a higher hit rate. Perhaps that's where my comfort comes from. And I wanna ask you, what do you feel is a lower limit of this hit rate? Big numbers. I mean, would you consider a system that has a 10% hit rate? Or I don't know, you will feel more, you would think that's more reasonable, a system to have 20% is okay. What do you think?
Well, my experience on the backtesting does not line up with yours. So I think the longer term systems are going to have a great hit rate. You can sort of it can only be so around 40, I think. So now that is with one entry, one exit, and a stop loss. I think the hit rate is going to be highly influenced by the size of the stop loss, not the 150-day breakout or the 125. So if I'm getting in at the 100-day high and getting out at the 75-day low, um, that's not going to really determine my hit rate. That's going to determine my length of my average trade. So the longer term my exit, the longer I'm going to stay in a trade, of course. Okay. So the hit rate, I think, is pretty much going to be, if you're risking 2 ATRs, you're going to have a lower hit rate than if you're risking 5 ATRs. But you can do this back test, and it kind of optimizes out to where you can kind of see how that plays out, and you can make your choice. I think it's totally fine to have a 20% hit rate or a 40% hit rate, but it's pretty much going to be due to are you risking 2 ATRs or 5 ATRs or 6 or 7 or whatever. So I think that's been my experience. But I don't discount the hit rate at all. I want to maximize that hit rate. I've tried to figure out ways to do that by looking at ways to improve my entries. But I think if you're going, like me, talk about preserving capital and defining capital as your initial investment and your realized profits and losses, and then that's what you're trying to protect. And you're being very cavalier about the open trade profit as it relates to the drawdown piece. I love the open trade. I don't want to see it go away profit wise. And I'm going to try to figure out a way to hold on to as much of that open trade profit as possible. But I'm not going to be concerned with the risk part of that volatility or open trade drawdown. But if you're going to be so focused, like me, on preserving this capital, well, a direct impact on that capital is your hit rate. And how much are you risking? How many basis points if you take a full loss? And then the hit rate. And the hit rate really is going to determine kind of your risk of ruin or your risk. It's going to have a big impact on your risk of ruin or your risk of having a certain drawdown. Uh, so I think it's incredibly important to get that hit rate up in the 40s if you can for those reasons. But I think inherent to proper trend following, you're going to there is a limit, and if you try to get above the 40% by profit objectives or getting out at the highs, half my position I'll get out after the market goes 20 or 30 or 50 ATR profits, then that's not legitimate, robust trading. And you're telling yourself, well, this helps me increase my uh, hit rate. I'm not for that. You're getting into other problems. But I don't think we should ignore the hit rate. In baseball, the number of runs scored is directly correlated with on base average and slugging percentage. So those two things are very important. You can strike out a lot and not have a great batting average, but still be very productive. However, batting average is embedded in both of those two numbers. So I think in everything that we do as well, we want to be very careful to have a pretty good hit rate. At least that's the way I approach it.
Yeah, thanks. I got a little lost on the baseball analogy. if you're talking about soccer, I would understand a bit better coming from Brazil, but that's fine. I get it. Thank you.
Just be aware that some of the classic trend followers that don't volatility target, etc., they're naturally going to have a lower hit rate than those that do practice volatility targeting. So someone like a Paul Mulvaney is going to have a, somewhere between 30 to 40% win rate, but he is going to have a very volatile equity curve, but then he's going for the big home runs when he gets them. So his reward to risk relationship is so strong that he can absorb that low win rate. But ideally, my gut feel tells me, Bruno, that you're perhaps dabbling with too short-term timeframes, because what we should be seeking to do is increase the relative frequency of outliers in our trade distribution. And the techniques we do that is through this very wide diversification, but it's also through medium to long-term look-backs. That is a method we use. It's a bit like distilling a fine whiskey. It's a method we use to increase the relative frequency of outliers in our portfolio distribution of trade returns. So if you're finding that you're getting down to the 20% level of win rate, there's too much noise. That's my gut feel. There's too much noise in that signature, which is sort of tending to suggest you might be dabbling with too short-term models. Not sure, but that also might be one of the symptoms you're facing, why you're getting knocked out of trades a lot. Which means that in your workflow, you would need to somehow develop a method to increase the trade sample size with a lower trade frequency per return stream. Ideally, we're trying to prevent overtrading and only focus on those outliers.
Yeah, I don't trade these longer term systems. My exits definitely are not as long term as 100 day as we talk so often here. And I have this I think we call it chandelier exit, or something like that. And my trade drawdown is I think it's too small. But just that as I was saying, I need to rerun my back tests in a way that that I feel comfortable enough to trade them. And when I say comfortable, I mean looking at the back test numbers and feel confidence from that. Confident. I think it's more precise word than comfortable. But yeah, thank you all.
Yeah, look, just one thing to be aware of. Some of these methods of back testing, they naturally default to exclude those system models that have less than a certain number of trades per return stream. Now, you need to turn that function off when you're dealing with outliers, because over a 30-year period for a single return stream, you might only be participating in that market 10 to 20 times. So those there might be some sort of thresholds in your workflow process which is preventing you from accessing those low sample solutions. And you want them, as opposed to those that might demand a trade sample of, say, 50 trades or 100 trades or whatever. That forces you into the overtrading territory, which you don't want.
Oh yeah, actually my workflow is all I raised it from the ground. I've programmed it all, but I feel there are some bugs within it that perhaps are getting me the wrong impression or the wrong numbers. I need to make a reassessment of it all. That's for sure.
Hey everybody. I've done a lot of back testing recently, and I've been trying to get the highest ATR return per trade on average. And when I back test trying to maximize that particular parameter, I come up with a hit rate around 20%. But kind of like Jerry's mentioned in the past, what you're not seeing there is the return of those trades that you got stopped out on early and had to resize. And that's kind of it's kind of hard to compare that. But if you just look at trying to maximize the ATR return per trade in the back test, when I do that, I come up with tighter stops and a lower win rate, but it produces the biggest outlier trades as a single trade, but not necessarily taking into account getting stopped out of a trade earlier and then having to resize. When then your ultimate profit is lower, but your ATR return per trade is higher, if that makes sense.
It does make sense, and I can see that happening if you used a metric such as ATR per trade. But I'm wondering whether you should be using a different risk metric that's looking at not only your outliers but your drawdowns as well, and the relationship or the balance between those might sort that problem out.
I guess my thinking in doing that was trying to limit the path dependence of the test, where certain big trades, like if you're going to focus on like dollar profit, I feel like it makes a test more path dependent on the series of trades where when the outliers occur and how that affects the the equity curve of the entire test. If you can, my reasoning for looking at ATR return per trade was to try to, I guess, to make the system most efficient, the entry and exit signal most efficient, and kind of limit the effect of path dependency over a long series of trades linked together, if that makes sense.
Gotcha, Seth.
Yeah, so I think my backtest results have been the opposite of that. And it's because there is only, all of the systems are participating in the same big trend. So the 100-day low system, it's going to exit at the 100-day low. It may get out once or twice before that trend has gone the distance. And then the 200-day low exit, it never got out. No, it stayed in the whole time. It never had to resize. And so both of those over time make the same amount of money. But it's obvious that the 200-day low, the longer term, it has a higher average trade in terms of ATR because it does fewer trades and it stays in that trend. And so it's really not doing anything too special. Like I said, from 100 to 200, I'd say they make about the same amount of money, but the 100, the 200, the 150, the 175, they just all do fewer trades. They're in the same trends. They just don't, and they give back a bit more, from the peak, let's say, but their average trade is higher. I think it just makes me think that when people, not that you're doing your research incorrectly, it's just that people have different ways of doing research, and then we get on and we talk about it as if we don't have different ways, and we come up with these different results. But I do think that the hit rate is going to be more determined by the size of the ATR. So I would encourage you to go and do some back testing with no ATR stop loss. Yeah, and see if you can't get closer to what I'm talking about. Just take the ATR stop loss off and then do these breakout systems. And then I think you'll see that, the longer term systems, they have a higher average trade, but they make the same amount of money as the shorter term systems, within a certain band. And they're not anything special. I trade both medium to long just for diversification purposes.
Yeah, it's interesting, Jerry, because I extensively use this process called multi-market testing. So in other words, if I'm doing a back test on a single market, let's say I want to trade Euro USD, I'll do a back test on my Euro USD. I'll come out with a result which I think is great, but it's inevitably curve fit or overfit to Euro USD. However, when I start applying that exact same strategy to 30, 40, 50 other markets, it naturally pushes the ATR out. It naturally increases the ATR on the initial stop, the ATR on the trails. And I find that once I've completed this test across all of these markets, what I'm effectively doing is I'm putting that model across alternate histories. And I'm finding that it's eliminating this overfit nature. So when I've developed those models, I then can universally apply them to any market. And it naturally has very wide ATR-based stops and trailing stops. And it's gone away totally from the original proposition against a single market where it's, you've got this very tight ATR, this magnificent back test, this great outliers. That's sort of like, to me, an illusory dream of overfit properties associated with a market. And that's why I make sure my models are universally applicable across any liquid market. And that sort of removes the sort of the tightness of the models, creates much looser pants, what we're after.
So when you're testing and you're doing that, what are you optimizing for compounded annual growth?
So when I'm doing it, all of my stops and trailing stops are ATR based. So they're normalized. So no matter which market I trade on, we're normalizing the price data. I'm using just a simple metric, the MAR ratio, for the return stream, just as a measure to accept those that produce a positive MAR. I'm not after a significant good MAR ratio. I'm just after an acceptable MAR, and then I'm multi-market testing that across 40, 50 other markets. And they must have all a positive MAR or a positive profit factor across all of those 40, 50 markets to be acceptable as a universal strategy, if that makes sense, Seth.
Oh, that makes sense. That's interesting that you actually look for a positive MAR in each market. Considering how we talk about often, we look at like a back test and see that maybe like cocoa or coffee or whatever have been mentioned in the past have never made a profit. It's an interesting idea.
Yes, it puts a very heavy, even though it's a very low requirement to just have a positive MAR, it is actually putting a very tough threshold across this universal strategy that's applied to any liquid market.
So Richard, comment on that and compare that to the Quantica paper that seemed to say continue to maximize your diversification and trade as many markets as possible, and do not pay attention to historical performance in any individual market. That was a pretty good paper. I think we both liked it, but it sounds like that you may not agree with it as much as I did.
No, I totally agree with that paper because, these outliers, they're these universal features of market behaviour, which I believe, and therefore they can be applicable to any liquid market. So therefore, when I'm testing across a universe, because I've got finite capital, Jerry, I don't have unlimited capital like you, so I can't afford to have 175 markets under diversification. I've ultimately got to make a decision to restrict my market universe. So what I'll do is my models, I'll have a practical universe with maybe 100, 150 different markets, but I know I can't trade all of them. And I'll apply these universal models across those markets. Now, whichever ones pass the greatest number of markets identifies the most practically applicable universal model, and those markets that it passes are defined as the universe I will trade. Does that make sense? So therefore, I'm not trading the complete universe applicable, 150, say. I'm trading maybe 70 that have passed the MAR test and are universally applicable across those 70, 75 markets. So there is a tiny bit of overfit nature in what I'm doing, but it's simply because I've got finite capital as opposed to unlimited capital. But that paper by Quantica is exactly the argument we're saying why we prefer absolute momentum models to cross-sectional momentum models, because the reason we trade margin products like futures and CFDs is to achieve maximum diversification. But when you don't have that ability to trade margin products, so let's say you're in a world of equities where you're not trading leverage products and you've got $100,000 of capital, you might only be able to allocate $10,000 per equity. That means you've got 10 markets you've got to select from that equity universe you trade. And it forces you into this selection methodology where you're trying to select the best trending equity markets. Now, we don't want to get into that situation because we recognize that there is no preferred signal. Each signal potentially could be our outlier. So we want maximum diversification. We must trade leverage products, we must trade margin products, and we must go for as wide a diversification with a smaller bet size as we possibly can get.
Okay, so if I could just rephrase that and see if I've got it right here. You will make sure that each market has a positive MAR, even though that doesn't matter, even though it's unnecessary and it doesn't really help. You still want to do that, and if you could trade 175 markets, you would not look at to make sure that every market has a
Yes,
positive.
if I could trade 175 markets, I wouldn't be worried about MAR, Jerry. The reason I'm using MAR is to give me a restricting mechanism to work within finite capital constraints, if that makes sense. So yes, I am cheating a bit, but in a very weak way.
Okay, we all cheat, and that's. And you know what's interesting about the Quantica paper, and I love Quantica. I love those guys, and I think they're really smart. And they're friends of mine. I spoke at their conference in Zurich a few years ago. Great people. I follow them. They write amazing research papers. Um, but what's interesting about that paper to me, and once again, I might be interpreting it slightly incorrectly, is that they perform this research using a trend following approach that they don't use in real life. It's something called this generic trend following models that they've created to sort of compare their more sophisticated trend following to generic. And I think this generic, I think they use the word generic in the title of this research model, is to, they want it to be sort of correlated, I think, to some of the, another one of the indexes that CTA trend following index, and now escapes my memory. But their Quantica's approach, which is in the public domain, the philosophy of what they actually do, does rely quite a bit on relative strength in the different markets, which I'm not sure if that's material or some sort of a contradiction, but I do think that it's kind of interesting. So I have read their monthly newsletters and participated in their Zoom and webinar meetings where they'll say, well, yes, soybeans were in an uptrend, but we got out because the S&P was more strong this month, and so we sold our soybeans and we bought more S&P. So I guess on a shorter term basis, they do think that you can time the markets in that way based upon.
Maybe that's why Arta didn't really like that research article, because it does go against the grain of what they're doing. But the research was pretty pretty strong in suggesting that there was no sort of enduring benefit to these relative strength methods, and that absolute momentum was the way to go. So I'd be interested to see if that's actually going against what they do.
I think that we to selection the markets is a little bit against something, a little bit against transform philosophy in general. But as I said before, I select the markets to trade because I have not much deposit, and so I tried to predict what markets are more possible to be in trend. It's not maybe the best decision, but I don't see any other choice. But of course, if we have a big amount of capital, necessary amount of capital, we must understand that, as I have said before many times, it's a general rules, universal rules for the markets, and even more, it's universal rules of our nature. Trending, ability to trend is a nature law of nature. I'm sure, absolutely. So, of course, if you have 100 markets and 170 markets, there is we must only think maybe this markets to be liquid enough, nothing else. Because even if particular market, and theoretically didn't in its history did not have trending period at all, then there must be a simple reason for that. And if we don't see this simple reason, and I think in most cases we will not see this simple reason, why it is so. I can understand why VIX is not trending, because it's volatility. I can understand it, not in 100%, but in general I understand. But if we are talking about maybe iron or something like that, maybe not very good example, but when we are talking about a commodity market that was not trending in its history, but there is no reason to be so. No big reason. Of course, there are a lot of reasons why it is so. But there are no big reason why it must not be trending in the future. And so, why we must not add this if we have enough money? Why we must not add this market to our portfolio? Because sooner or later we will see a good trend in this market, and I'm sure it will be so because it's laws of nature, laws of the market.
Yeah, I was just going to say, I really like it when really smart people write these papers that agree with me. I love that. And so I can't write these papers myself. And that Quantica paper was just right up my alley, and I loved it. And so my goal, my mission, or my role in life is to read these papers and tweet them. And so I'm helping. I'm helping them, and they're helping me, and they're giving me confirming my research and my thought process. My thought process is in research. I want to get in this trade, and I want to stay in it as long as I should, and then not give back too much profit later. In other words, I'm going to try to maximize these big moves, irrespective of anything else. The other stuff I'll figure out. It'll be a bunch of small winners and losers, but I'm only interested in what historically has worked best to stay in these trends and maximize that profit. I'm totally fine with making the most amount of money on a trade and having the biggest drawdown as well. And I think sometimes those may be somewhat correlated. I have a question from Andrew in the room chat. Basic exit and stop loss question. Would my stop loss ever be set to get me out earlier than my exit signal? If so, why would I put a stop there? Does anybody have a good idea on that?
Well, I make sure that my initial stop is always that's the first exit. My trails sort of tend to take over after a certain ATR has been reached, and my trails will start triggering. So I'm never going backwards. I'm always. It's a bit like the chandelier exit that Bruno was talking about. I'm never going backwards, but I am progressively ratcheting up my trailing stop from that initial stop position. So, once I've set my initial stop, my trail is never below that. I know that might be different to some of these profit exit techniques like the Donchian exit, which might actually be lower than the initial stop, but it's certainly something I don't do.
Well, and
Yeah, I agree. I agree with
I'm
that.
sorry.
Sorry, go ahead, Brian.
Oh, I was just going to say, I think Andrew had commented on the 40 and 20 out about, because I think, I don't do that system, but I think they have like a 1% or a 1 ATR on that initial breakout, and then let the trailing stop, the 20 out trailing stop, get to the ATR. And I think that's because he was saying he was marketing it to retail and knowing that the folks that are doing this may not have the liquidity of the larger, those of us that have been uh, doing this for a while. So I that's the only thing I can think of as to when you might do that. And I don't know what his back tests are, and I don't do it, but I just know that he did specifically address that when I watched his video one time, because I thought it was just unique and different.
I just had one, I guess, point comment back on the whole research piece that I found interesting. So I was doing a little bit of work earlier on, and what I would expect to see with longer term breakouts or systems, I'd expect to see positively skewed results. Now I'm getting negatively skewed results over everything except shorter to medium term systems. And I initially thought that was because of a sample size. So I figured, listen, if I see over 1,000 trades or something, I should see that creep up to the positive or positively skewed. But I'm not seeing that. I guess I just wanted to kind of get some opinions as to why that might be. I don't know if the short side is contributing to that, but over the long term, I definitely thought I'd see more positively skewed results for longer term breakouts. We're talking about 200, 300 days. And I'm not seeing that. I'm seeing this sweet spot kind of around the 100 to maybe 200-day range. So I just wanted to see if anybody had any thoughts as to why that might be.
You're not using profit targets, Boris? You're letting profits run?
That's right, and then that's the interesting thing, because I thought that by letting them run, right, those longer term systems, I would expect them to pick up those longer term profits, right, those moves. But I'm still seeing it being negatively skewed, and I think it's because of the short side. If I back that out, I'm seeing it positively skewed. But like I said, I was just kind of preliminary looking into it. I think, if I'm not wrong, Rob Carver wrote on this, and I came across it, which is kind of got me interested about it. He said with enough sample size, you should be able to see it, positively skewed, because this is what I thought is kind of part of the edge or contributes to it. But I don't see that. So I don't know if it's something that I'm doing in the calculation of the actual of the formula, but I've tested it against other markets and it seems to be okay. So I don't know if you guys ran into that as well.
The only thing I
Yeah.
could suggest is that you might your trade distribution might not have enough outliers in it. In other words, your systems might be too short term. You might be getting too much noise in there. I certainly find that I inevitably go towards positive skew with all my models as my sample size increases and I get a greater frequency of outliers in my trade distribution. Those outliers significantly skew that portfolio distribution to the right. So yeah, I'm not sure. I can't understand why you're getting that.
Yeah, no,
Boris,
that's
are you
sure. Go ahead.
calculating these returns on a daily basis, or are you calculating on a trade basis? Because the skewness of trend following is more evident on the trade basis, and if you're calculating on the return of the portfolio, not daily, go for quarterly or yearly, and then you'll get this skewness will show up.
Yeah, that's what I thought as well. I'd have to double check the calculation because it's obviously over periods. Now I was pretty sure I set it over monthly or quarterly. It was definitely longer term because you would obviously expect that window to show that there, but I'd have to double check. It's just something that I came across, which isn't the first time I read about it, and that's what piqued my interest. Like I said, I read something about it from Rob Carver, and there was also an article about it from the guys at Quest Partners. I believe that's their name. And they were mentioning that even though they see the longer term breakouts are overall more profitable, that they're seeing it that there's more positive skew with shorter term systems. Now, when we say shorter term, we're not talking about 20 days, potentially 50 to 100-day range, and that's what kind of caught my attention, which is what some of my research confirmed. But if you guys are saying the opposite, I might have to check that out, and potentially I made a mistake somewhere. But I'd love to get your opinion on those two articles. If you just type in Google like Rob Carver, Skewness, or Quest Partners, I think they had an article there on their website. About something, I don't know, black box trading, something like that, but it talks about how shorter term systems have they're more positively skewed. So I thought that could be interesting.
Boris, just be aware. So the when you go trade by trade, that has the highest positive skew. When you go to a daily method of calculating skew, that produces a slightly lower positive skew. As you go to weekly, then to monthly, as you step out, the skew decreases, and that's because when you're consolidating in a monthly period, all of those trades, you might only have 2 outliers in that entire month, or 1 outlier in that entire month, but you're accommodating in that entire month all of the linear losses in that monthly distribution. So your skew decreases. So ideally, to see your positive skew, and with nearly all of the things we do in this classic trend following world, we look at things on a trade by trade basis. That's the only way to look at it, because these other methods do dilute the information. So I would always recommend looking at it on a trade by trade basis.
Got it. Yeah, no, I'll definitely double check. I know I set periods. I just can't remember what I set the periods to, whether it was weekly, monthly trades. I'd have to double check, but it caught my attention because it kind of, I don't know if I read the articles and was inspired to prove them right or wrong. I don't know, but I'll double check. No, thanks for that.
Yeah, I think we might be getting back into, are we looking at the size of the trade, each individual trade, or are we looking at rate of return, as Richard said, and someone else as well? So I Googled just now what Alan said. He had a good, simple explanation about skew in the podcast with Niels. And he said, basically, if you have a positive skew, your losses are going to be your wins are going to be much bigger than the losses. So trend following has to have this positive skew because we're taking small losses and we're having these gigantic profits, and we're not paying attention from a trade by trade point of view of the drawdown at all. What happens between the entry and the exit is lost. There's no information there. We're closing our eyes. We're pretending it didn't happen. We have a very healthy average trade. We have a very healthy growth rate, return rate, compound annual growth rate. But what happened in between the entry and the exit? There's a lot of stuff going on there, Jer. Nothing. I didn't see anything. I'm ignoring it. So it's impossible for robust trend following to not have big winners, 5 or 10% of the trades being huge outliers. The biggest, because what? Because we're letting them run. But it has to be measured on a trade by trade basis. If you look at my Twitter page at the very top, the banner up there is that is a bunch of trades, not rates of return. So modern non-classic trend following drags us into this vol targeting, the equity curve, the drawdowns, the smoothness of our returns, and looking at things in terms of rate of return. And the Neanderthals amongst us are like, no, don't pay attention to that. It's trade by trade. This trade made 1 ATR. This trade made 2 ATRs. This trade lost 4 ATRs. The next trade made 200 ATRs. Yeah, it's not possible for systematic, classic, generic trend following. If you measure the trades properly, it's going to be skewed, positively skewed, and we're not setting ourselves up like a buy and hold S&P investment that is going to have a big, huge loss one of these days to wipe out a lot of the profits. Okay, we have one more question. We can tackle this. On open long position, what should I do if the market opens gap down, the price goes below my stop order, and by the time you notice that, the market has recovered halfway, but I think it's still an active sell order. I think on that one I would sell. I'm happy that I got a little bounce there. Where was I when I wasn't paying attention? But now that I am paying attention, it's still a sell. I need to still get out. I'm not going to wait for it to go all the way back down to the low, you know. Um, but let's make it more interesting. Let's say that I missed the exit. I've had this happen to me once. I forgot what year it was. I think it was the late 90s or early 2000s. I was long crude and I got, my exit got hit. It was a big, huge crude uptrend. I could find it probably. Big, huge uptrend in crude. And I ended up, it hit my exit, but it rallied so fiercely before I could even put the order in that I kept it. I talked to Niels about this because he was discussing this with someone the week prior, and I sort of disagreed with their opinion on this, that, follow the system, get out. I think that it's also okay that if you get this windfall profit where you can kind of say to yourself, well, I'm going to stay in this trade. I'm going to be very thankful for this luck I had, but I did have some luck there, and it rallied so forcefully, multiple ATRs from my exit, that I'm going to hold on. And look, if it goes back down there, I'll pay more attention and I'll get out. And in that trade, it really did recover and the trend continued. So I got really lucky on that one. And you need some luck sometimes. And I think if you stick with a systematic approach on how to handle these things, that's the best idea. And if your idea is, nope, if it gets touched, I'm out, regardless of what happens next, then I think that's fine as well. But playing for the outlier, I probably would default to, maybe I'll get lucky this time. I have some free money, and I have an idea that I may get even luckier if that trend continues. And so I think that is fine. Yeah, being consistent is the most important thing. It's not enough to add trend, to add diversification, to be kind of trendy, to take small losses. That's not enough. That is not going to get you where you want to go. It is the consistent application of those good rules that will, you just can't be kind of a sort of a trend follower and expect to get as much money as the trend followers. As I said last week, if your system is mediocre and you just are relentlessly applying it, doggedly applying it, you'll get pretty good results versus I sort of use trend. I try to take small losses. I try to combine the trend with the fundamentals. Um, no, 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 no. That's not nearly what you want to do to be consistently successful. And, just be mediocre with your trend and be hesitant to get out of those really wonderful trends. Fight against, be the last one standing, be different, and fight those emotions.
So, as I understand from different people who say that they maybe don't have that much capital as Jerry does to apply all the classical trend following stuff like trading all the markets, etc. So basically, to become a classical trend follower, you first need to do something else, like, I don't know, trade meme stocks discretionarily, or somehow raise more capital to be able to trend follow. And so I see here in the chat also someone wrote how to 10x your money in Forex. So that's funny. Just kidding.
That's the danger of having chat. But no, I don't agree with that. So I think you should trend follow um, and utilize these principles as best you can. Um, and you can trade a lot of stocks, and you can trade ETFs, and you can do. And then if it's only turns out to be 20 markets, a couple of bond ETFs, a couple of currency ETFs, some commodity ETFs, I think they're still okay. Hopefully, did wheat shut down the wheat ETF? I'm not sure. And then a few stocks, and it's only 10 or 20 markets. That's fine. Just I think it's very important to be consistent and have that fixed universe. And then as you get more capital and get more successful, you can add a market. And so maybe today you start with 10 or 20, and then in a few years you have 15 or 25, and so you just keep doing that because you don't need 175 markets to be successful. You'll be more successful, possibly quicker. You may, have a smoother return. You'll hit more of the outliers, but there will be years when I underperform only because I was trading too many markets. And someone who trades 50 and has a really huge allocation just nailed it, because that was the sector that really moved. Energy. I mean, my energy positions are so small. I mean, think about it. It's 5 or 6 markets out of 175. So the only reason I'm not falling behind other traders now is there's other markets that are doing just as well as energy, let's say, or almost as well. So no, I don't agree that you need to, or you certainly should not veer away from this tried and true and approach that has a huge edge. If you trade it long term, the average trade is pretty juicy. And then, but then repent later when you've made money some other way, and now you can go back to doing the right thing. No, just do the best you can, start small, and practice. At some point in time, you might get lucky and get hired by someone who will give you a lot of capital because of something you said, you wrote. In that book, Taleb's book, The Black Swan, he says one of the most important things that you can do is go to New York cocktail parties, and you never know who you'll meet and who you can impress, and that can change your life. And so it certainly did happen to me.
Hey Marcus, I think about this question this way. The way we run our backtests, the way we approach markets is from a completely humble point of view, in that we don't know which market will perform the next, how each market will perform next. We don't know about the next trade. We don't know if the next trade in crude oil or soybeans or some stock will be the best one. In that way, it doesn't really matter if you're trading 170 markets or 20 markets, because you're either getting that winning trade sometime. But if you're trading 20 markets, it may take a longer time. Whereas if you're trading 170, you increase your chance of getting that one right trade that will make your year. So I think that when we have capital restrictions, we are just spreading the potential of profits a long time. That's the way I think about it. Now, you do have to pay attention all the time to your risk of ruin. If you're trading 20 markets because you can't trade anything more, then you do have to pay attention on the size of each bet. Provided you're protected from risk of ruin, then it's a matter of time.
Yes, well said. Now, one of the things that I wanted to say in response to that, it was just to reminded me that a few years ago, I had a different mentality where I definitely would say that, if you trade 50 markets or 150 markets, it didn't really matter very much. You're going to make the same amount of money over time. Over time, you'll make the same amount of money. But it's certainly not the way that I was taught. And then Richard reminded me of that's not the way I was taught. I came to the conclusion years later, getting away from my mentors. And the problem with that idea is this, in a nutshell: correlated, because having that idea that trading, if you trade 50 markets versus 150, you can make the same amount of money. A huge part of that philosophy has to be that correlation works, and it doesn't really work in a trend following way, because a correlated market, um, like crude, heating oil, and unleaded, that's three of them. One of those three can have an outlier and the other two won't. And that has happened to me more than once in heating oil. I've told you that story. So that is the underlying problem. That it's not that, well, if I trade 50, it's going to be a little bit more bumpy, and it's going to be a little bit more volatile with the same risk budget than if I traded 150. Yeah, the problem with that is, you're essentially going to be making these choices by saying, if I'm only going to trade 50, then I'm not going to trade crude, heating oil, unleaded. They're all correlated, and Brent and gas oil. Why would I do that? Well, the problem is the guy who's trading 150 is going to experience an outlier in one of those correlated markets and the other ones don't have that outlier. Um, so that essentially is the issue. So you probably will underperform over a long period of time with a smaller portfolio, because the correlations don't hold up all the time. I think it was Moritz who said, or someone said, I like this little saying: look, it has a different name on it. If it was crude, it would say crude. It doesn't say crude. It says heating oil. So I'm sure if you talk to people who pay attention to fundamentals and ask them, hey, is it possible that heating oil could do something crazy and heating oil and unleaded sit there pretty much? I'm pretty sure they'd say, oh yeah. If you understood how these markets work and what can happen. And we see this now. And I think we're going to see it in the future with currencies that are sort of correlated to each other. And now we're just getting so much evidence of things we didn't even think were related to supply and demand, influencing and creating shortages.
I was just thinking here that if I had more capital myself, I would just invest with Jerry, lock in my money there, and maybe leave just a small part to myself to trade meme stocks and still have the fun.
Oh, that's always a good choice. Give your money to Jerry. Yes, I can definitely recommend that. But you do have to have fun. So I'm going to take back my criticism of trading meme stocks. So no. You need to have your fun and enjoy And yeah, and I think the trend following can be fun. I mean, so often I have, I'm kind of uptight about what's going on. But then when I get in my chair at 8 in the morning, which is what I've been doing since the end of 83, I mean, I'm just in a happy spot. And I can just always go home, go in the day being optimistic and thankful. I mean, if I can't be optimistic and thankful from all that I've seen, all the positive that I've seen, and then the only time I really have regrets is when I haven't followed my system or I've gotten away philosophically from what I believe to be true, what I've experienced and back tested and told, and just feels, in my heart is true. Then who can? I mean, so I owe it to myself and everyone to not to let these markets impact me in a negative way. I mean, that's one of the things that Rich was so good at and so intolerant of, and that is just negative emotions. It's just a game. We're playing it. We have an edge. We're going to win. And when you have a positive edge, the most important thing is to exercise minimum boldness. In other words, trade small enough and do all you can to make sure that you survive and never get kicked out of the game. Whereas when the odds are against you, you need to use maximum boldness, which is go into Vegas, take all of the money that you plan on spending, betting, put it all down one time, and then walk away. Because the more you play, the more you're guaranteed to lose. Where with us, the longer we play, we're increasing the chances that we're going to win.
Yeah, it is never wrong to have positive attitude in trending, in trading, and also in life.
I like that Vegas analogy. I mean, not like I'm booking a flight to go to Vegas and put it all down, but I like the time in a system with an edge. That really hits me. Thanks, sir.
It's you just can't underestimate the importance of that we had of being told, the secrets to trend following and trading, and not only that, but there was definitely this emphasis on we're not here to tell you how to trade today, and for the next few years, we're going to equip you to trade um, philosophically so you can adapt over time and be successful and stay in the game. It was never a situation of, it was always a presumption that some of these specific parameters and ideas that you get in December of 1983, they may not last your whole life, of course. So there was a huge emphasis on the intellectual philosophy of what we do and why it works and how to think about trading and life in general. And then number two is once you get that, to be put into an environment where there's just constant positive feedback. And it's not like the real world where you have clients, but it was just if you're doing the right things, you will be rewarded, irrespective of your returns. And going through that is just invaluable. It's like I've said, it's a bad analogy, but it's like giving someone a manual and saying, go be a Marine. It's all written down here in this manual. Now go off and be a Marine. Versus, if you spend some time in boot camp with the people, you're probably going to, and that's what we did, being there with them and listening and watching how they responded. And plus, like, Lulu, they were the nicest people on the planet and the most forgiving and understanding and the least emotional, negative emotionally. There's no negativity. It was all positive. And so then, I just don't think we made enough of that opportunity from a business point of view, like some of the other competitors, CTAs, that they were much better businessmen. And I think to a large degree, when we came out of that environment, we were heavily influenced, personally by our mentors. And it was just always a situation of where we would just assume that we would never have very many clients anyways. This was a kind of a way to free yourself from corporate world and clients, and to, like, every day is like a vacation. You have nobody to answer to except yourself and the markets, and maybe you have a few clients and family members, but it was just this ability, to not have to deal with the real world and real job. I remember someone in the classroom saying, I've never had a real job before. And I was just coming off of being in public accounting. That's a real job, and that's just no fun, right? So we were not, we were fully equipped, better than anyone could possibly be, on how to trade, but we didn't really have a good focus on how to create a big business. And I went to a good business school. I went to one of the best business schools in the country. But when given that opportunity to not have to, to have an approach and a methodology that did not require me to have a big business to enjoy life and make money, I just embraced it totally. So forget all my business training or whatever. I was really willing to not have to try to make a go of it, and not have be put into sort of a typical corporate world.
Yeah, that's a secret to success. And thanks for sharing, Jerry.
Hey, Jerry, a couple of years ago, there was that trend following masterclass with you, Niels, and Moritz. I think it was 2018. I don't know. I was starting to listen to the podcast at the time, and I always wonder if there will be a second round.
Oh no, we did that once, and it was just a couple day get together in New York City. And it was mostly just to answer people's questions about trading, and one-on-one, and have dinner and hang out together. But I get asked a lot about another turtle program, and I understand, it would be really fun. And I just think the most of the time when I deal with this, when people ask me, like, it'll be, I'm not trying to get negative or anything, but it's kind of like, hey, Jerry, you should do a turtle class. And because you got so fortunate, don't be so greedy and share what, with everyone else. But we do a lot of sharing, on the podcast, on Clubhouse. And so I think if I would have gone to Chicago in 1983 and someone had told me, like, I'm going to give you the keys to the castle, but I'm not going to give you, money to manage, but your knowledge on trading is going to be amazing, especially compared to what it is now, and you're going to be able to compete with traders all around the world. I would have done it in a heartbeat, right? But now when most of it comes up now and people request that, they're not satisfied with just the answers and almost giving it to them on a silver platter of how to trade, because most of them will disagree that you can't, just not pay attention to volatility. You got a vol target, blah, blah, blah. No, they want the money. That's the most important thing to them is, I need $1 million or, $5 million to manage too. That's what I want out of this turtle program. And I'm like, oh, well, I think if that's your attitude, I don't think you would be someone I'd want to really spend time with, because it should be enough that you can walk around with all this knowledge in your head, and then you can figure out how to get the money. But people want the money from me, and and like I said, I think when Rich talked about I could print my trading rules in the front page of the New York Times and nobody would follow them. I think a lot of that, at least to me, when I heard it the first time, it was that people would find it too difficult to follow, the volatility and the drawdowns and the losing trades. But now I feel like it's more like, no, you're wrong. I'm not going to follow those rules because they're wrong. You need to pay attention to those things. I need to have this strategy fit my personality, and my personality won't accept drawdowns and volatility. So I feel like we're talking about a lot of good things here, and it's incumbent upon everybody to learn and Google and go find money to trade. I think I'm doing my fair share.
Absolutely. I'm not questioning that. I was talking about the get together, as you said.
Yeah, to get together, I think we should. I remember, even in the class, I remember that when dealing in the guys, Rich and Bill and Dale, everybody who taught the class, and they were there was this healthy respect for, we're not going to like get too much into how I do things. We all know the fundamentals and the basics, and so once you get to that level, you need to work the rest of it out yourself. And what do you think is the truth? And I think that sort of healthy dialogue would be great for people in the clubhouse. Like when Richard can travel, we need to get him to New York. We all need to meet up in New York, and it would be so much fun just to sit around and talk about things face to face, like things we believe and things like that. Because I don't need to talk to Richard to figure out how to trade, and neither does anyone else. But I know my trading will be better, and my mental health will be better, with these sort of interactions. And I think these things are worth a lot, and it would be something that would be so much fun to, meet up in New York City for dinner and get together, and we would all learn a lot, and then get a lot of encouragement from each other, like we do here. But face to face would be fun as well.
Yeah,
I
look
like
forward
Brian's
to it.
suggestion.
That's a good idea. I actually did one such trip to New York in 2019 before COVID, just to meet a group of traders from around the world. And even though I was, I think, the youngest there, and it was more like older people group, it was still fun to hang out and talk and listen to all the experiences. So I would definitely be up to a plan like this.
Yeah, I mean, it'd be fun. I mean, there's been people on Clubhouse who heard that I was traveling to New York, and this was like in the early days of Clubhouse, where I just met up with somebody. We just had coffee, and so it's really fun to meet and to talk about, these things. You know, but yeah, New York would be, and we've had a couple of trend following dinners before COVID, I guess. Yeah, George, George, my devil's advocate friend on Twitter, and then Woody on Twitter as well. I think they've both been in the clubhouse. We've all met up before and had dinner in New York and chatted. They probably let me pick up the tab, so we need to change that idea.
Very
But
kind of you, Jerry.
what's that?
Very kind of you.
Yeah, yeah, very kind. Well, I'm gonna. Oh wow, we had a lot of questions pop up. Um, let's see here. Yeah. Well, anyways, we'll tackle some questions next week, and but if anybody wants to say something or ask a question, we've got a couple more minutes or 5 minutes if there's anything interesting. So speak up if you want to say, have the last parting words. Okay.
Don't fear the drawdown.
Love your losses. Yep. I love your, that was one of the, the turtle test, you sent your resume in the fall of 83, and they sent a test out, and it was 100 true false and I think 5 discussion questions. And one of the true false questions was, true or false, a trader should love their losses. And that was true. That is true. And I think it's more along the lines of, you have this system, you love it because it's going to make money for you. And so whatever characteristic it has, losses, wins, low win percentage, outliers, you should love it. And so, yes, you have to love those losses. Although, this battle of smoothness and equity curve versus trade stats, the sets brought up, average win, that's my favorite thing. Average trade. And what's your average trade? That is my favorite stat, and I believe in that wholeheartedly. But before I signed on, I looked on Twitter with that tweet I made yesterday about don't worry about drawdowns, or if you have a big drawdown, it's kind of good because now you're less likely to get out too quickly. One of my friends who doesn't really go with the classic trend following, he was like commenting about that and saying, oh gosh, we got to have a debate about this. So this debate is never going away. It's just like a political debate. Republicans, Democrats, conservatives, liberals, it's
Liberating.
never going to go away. Never,
Yeah.
never. So, and I don't even know why I care. why do I try to help these people? Because they're not going to listen. And I just, it's just kind of fun. Okay. Everybody, thanks a lot. Have a good weekend, and we'll see you next week.
Thank you so much.
Thanks and bye.
Thanks, everyone.
Bye.
Bye, guys.
Thanks, Tom.